Hi, I want to give you a quick video update of what's going on in the world these days, what's going on in the market, the economy. We had a bit of a surprise out of the Fed today. Janet Yellen announced that, well, she has no intention of raising interest rates anytime soon. The Fed removed the phrase patient, meaning that they're going to be patient, but supposedly people would think that meant less patient. But what they implied is they're going to start look at the inflation rate. These are the things I've been writing about in my newsletter for months, saying that the unemployment or employment picture wasn't that important, that they needed inflation, because why would you raise interest rates in a deflationary environment? Raising interest rates only slows down the economy, which would make interest rates lower or a slower growth economy. You raise interest rates when you have an overheated economy. What we have is deflation, just like I talked about in the book Facing Goliath, deflation continuing. We have the increasing dollar, because if they did increase interest rates, the dollar would have gone up even more. That would have killed exports in this country, and they knew that. They can't just simply let go of the dollar and let it run up against the yen and the euro. They've got to keep it competitive. They want a strong dollar, because a stronger dollar helps us. If you're going to go to Europe, now's the time to go, sometime this summer. However, also, if you're buying goods and services that are made in Europe, for instance, if you're looking for those marble columns you want to put in front of the house, or marble in the bathrooms, that Italian marble, now's a great time to get it, because it'll be 25–30% cheaper. So deflation across the country, across the world, is keeping everybody's interest rates down. The Fed can't raise rates, really shouldn't raise rates until there's much faster growth in the economy. Therefore, we saw the stock market rally. It was almost like a rate cut. So it's definitely a positive, and not until we see more heating up, much more growth, faster growth in our economy, do I expect rates to go up. And I've been saying, as you know from my newsletters, for months now, that I don't see any rate rise in 2015 at all. A lot of people thought it was going to be in June. It's possible it'll be September. I don't think it's going to be until at least 2016, again, for the deflationary environment that I talked about. This is positive for stocks. Now, it's not, throw caution to the wind. It's going to, at some point, it's going to slow down. This could be a year where you sell in May and walk away. I don't know yet. We'll have to wait and see. Earnings will start coming out in about 3 weeks. That's going to be critical. You got to keep in mind, a lot of big American institutions, conglomerates, international, have a lot of foreign sales. And with the stronger dollar, you're going to have a lot of headwind as far as earnings for big companies. So maybe the smaller companies will start doing better. So again, always have a plan in place. It's not about how much money you can make when you retire to get close to retirement. It's about, hey, how much can I lose, or how much can I afford to lose, or how much do I want to lose? So you always want to put that plan in place, stick to it, invest for need, not for greed, and make sure you're getting the right return with the least risk possible. It's what we do for our clients every single day. We're always working to do that. So if you have any questions whatsoever, be sure to give me a call. I hope you enjoyed this, and let's talk soon.